be collating the attendance mark as well. Okay, so that's what I'll be doing the next few days. So I'm hoping that by Monday or Tuesday you should have your marks approved by Rosie. So the way it works is we're going to mark it on Thursday. By Thursday evening we'll know exactly we're done completing marking, and then I'll collate it on the weekend. And then it goes through a process of approval. And once it's approved by the chair, it gets loaded to Rosie, and you'll see your marks immediately. Okay? So you'll have it, hopefully, by the time you start your second term in the summer. Okay? All right, so why don't we get started, everybody? So, first of all, welcome to the review class. And I want to start with perhaps a summary of the materials you need to know for the midterm. Okay? So these are the things that I call it things you need to know, right? So things you need to know. Is the lighting okay there for the video? Okay. Is that better? Yes? Okay. First thing is we need to understand cost. And cost, we have direct versus indirect. Variable versus fixed. Period versus product cost. Prime versus conversion cost. You guys remember that? Okay. And the big one, certainly the one that is relevant for Chapter 4 and Chapter 12, which are the main focus for the final exam, are the concept of relevant versus irrelevant, right? It's important for us to really have a good handle on relevant versus irrelevant, because what you'll find is you may get information that's provided to you that's not relevant, and of course you'll be asked to assimilate some of the information and then make a decision of what information you need to solve that problem. So we talked about the format. Somebody asked me earlier. So the format is there will be 15 multiple choice, 2 marks each, and they will all include a combination of calculation and theoretical. Then there are another set of multiple choice. There's 4 of them, worth 2.5 marks each. And they relate to a situational, I call them situational-based multiple choice. So I tell you a story, I tell you a case, and I ask you for questions. Some are qualitative, some are quantitative, and it's situational-based. Okay? And then there are bonus multiple choice. I don't remember offhand whether there were 3, 4, or 5, but there were 1 mark each. So there's certainly, I gave you enough there. And they are similar, but not exactly the status check. Okay? So they're similar in concept, and they're all concept-related type multiple choice. Okay? So that's essentially the format. Now, the second thing we learn, so this is to me is the thing that you need to know. So I'm expecting that you need to understand the different element of cost, right? The second is budgets. It is extremely important that you know, right, how to budget certain things. What certain things am I referring to? Well, the first one in our lecture notes was production, right? Right? And we make some assumptions about how many we need to produce based on, right, sales for the following month. So we always wanted to make sure that we make enough for our expected sales. Okay? So if you're not sure about budgeting, please review the lecture notes. The lecture notes gave you a good example of how to budget, starting from sales to production to materials. Okay? So from production, we're able to budget raw materials and labor, right? And then once we've done the production cycle, we're able to do the cash budget, right? Okay. So I'm going to encourage you between now and our exam on Thursday to please review the additional Chapter 10 handout. Remember that those 2 questions that I gave you guys? And it showed you how to do the budgets in its entirety, all the way to the cash budget. So there's a few, I can't tell you what's on the exam, but there's a few items in there that I was able to muster, okay, in the multiple choice. Sorry, I shouldn't have said that. Okay? So make sure you review that. Don't memorize, just understand, because obviously the situation will be different, right? So make sure you understand how to do budgeting. And it's not hard, right? It's a matter of understanding what the rules are, the business rules are with respect to how you budget for production, your raw materials, etc. Now, the third thing we did was CVP, cost volume profit analysis. And remember, CVP allowed us to calculate break-even analysis, right? In addition to break-even analysis, we also did margin of safety, degree of operating leverage, DOL. And remember, there's a relationship between margin of safety and DOL, right? And the one big thing we did was sensitivity analysis. Right? And in fact, that was part and parcel with what we learned when we did Chapter 4, Special Order, when we did transfer pricing. Right? So I'm going to put you in a situation where you have to decide what is the best course of action of a company, whether they should accept the special order, whether they should not accept the special order, or accept the transfer pricing situation. Okay? So I'm going to ask you a few of those scenarios where I want to know from your analysis whether it makes sense to do option A or option B. Okay? Now, they're not difficult, but they're just, it allows you to think back as a business person, right? What is the best course of action for that company? Now, the exam is obviously 2.5 hours, but you have, right, 2.5 hours to do it, but the exam is really written for a 2-hour exam. Same format as what we normally have. Okay? So you do have extra time to finish that exam. Now, the number 4 is we did ABC. And remember, I've already tested you on ABC, right? That was question 3 on the midterm. And so I just need to understand what those are, but I wouldn't spend too much time on there because, as I indicated numerous times as we were doing Chapter 4 and Chapter 12, ABC is very difficult to incorporate in special order decisions because it would change the dynamic of the question, right? And we've never really done one. So I would just need to have a general knowledge of ABC. Okay, because there may be 1 or 2 on the exam, the multiple choice. Otherwise, right? Just need to know it, right? Okay. Now, what else did we learn? we learned that in chapter 4 was probably the first chapter that we sat back and said, wow, this course is finally we're getting to use some of the tools that we learned in the past weeks. And one of the things is we learned short-term decision making, right? And the one that I told you guys about is that special order. What's the minimum price of that special order, right? And it's clear that you need to look at the capacity of the company. How much can they produce without refusing, right, their regular customers? That's really the first question, isn't it? Do they have the capacity to fulfill the special order? If they did, then it would obviously, the minimum price would be the variable cost plus some element of profit, correct? But if they don't have the capacity, that's where the fun part comes, right? Where you have to figure out what is the opportunity that we're going to lose out on refusing our regular customers. And that's essentially the fun part of this. Now, I like this one, but you know what? This one's good. This one we've tested you already, kind of, in the midterm, kind of. But it's going to come back again. I want to make sure you guys understand, because this is typically what management is being asked to do. And that's the skill. That's the content of this course. Is one day you're going to be faced with these types of decision. What do? Do you accept it? Do you not? Now, the second one, which is my favorite, constraint resource. And that deals with perhaps 2 or 3 products, right? And we need to figure out which of the 3 products we're going to stop making, which one we can replace, which one we can put first, second, and third. Depends on the contribution margin per constraint resource. And there's a good example in your textbook. And there's actually, I think there's one in this review question. But nevertheless. Right? This is kind of my favorite. So if I put a triple star, you know it's one of my all-time go-to. Right? Now, the second one is, to me, the make versus buy and the drop versus keep are essentially decisions that also are similar to this constraint resource, right? So we have to figure out which of these items which of the products we need to drop, and what's the overall contribution margin, what's the overall profit effect. So I would certainly look at this, and if you think about it, those are the two main things that we learned after the midterm, didn't we? This is one of them. The second one is coming up, called Capital Budgeting, Chapter 12. So if I'm going to study for this course, those are the 2 main things I would focus my efforts. Right? Okay. So the one thing that I want to make sure we all understand is, for most part, fixed cost are not relevant, right? Now, if I gave you a per unit fixed cost, because that's just the way the question is given to you, right? If I said to you the fixed cost per unit is $2, irrespective of how fixed cost is given to you, per unit basis, fixed cost does not change. So what you have to do is convert that fixed cost into a total dollar, and you completely keep it the same, irrespective of whether we accept or reject special orders. Does that make sense? So depends on how the question is given to you. That's why you really can't memorize some of. That's why this course is not about memory; it's about application, right? The concept here is fixed versus variable. Variable is supposed to change based on number of units. Fixed does not, irrespective of whether it's given to you on a per unit basis. Does that make sense? So don't fall into that trap. Now, what's next? What else did we learn? All good stuff, right? Chapter 12. These are the two main, I think, two main chapters I would do a laser focus on my efforts between now and Thursday. Okay? And this is more of a long-term decision. And there were 4 methods that we learned, right? NPV, IRR, payback, and ARR. And ARR is sometimes called simple rate of return, right? Accounting rate of return, simple rate of return. Now, these 3 cash flows. Always. If I gave you net income, I gave you some data about net income, just convert it to cash flow, right? This one is cash flow plus depreciation, right? And remember, all we care about is incremental. Incremental. Change. Difference. And whenever you do an incremental approach, you always look at it from the point of view of moving to that new machine or that new process. So if I do the new thing, if I do the new idea, the new machine, the new process, what is my change? What is my difference? That is the incremental that I'm referring to, okay? So always look at it from the point of view of the change. Now, there was a lot of questions about working capital. So normally, I want to clarify so that you guys can replay this back. Normally, working capital is something that the company needs to start the business or to start the investment. So it's a resource requirement, it's an outflow of cash. Normally, in the question, the working capital gets returned, comes back at the end of the project. So that is a cash inflow at the end of the project. So you want to show an outflow of working capital in the beginning and an inflow of cash at the end. The two are different because of time, value, and money. Make sense? Okay. Now, there are scenarios where working capital does not get returned. For some reason, it gets embedded into the investment. So here's what you do. For these two are easy. You just have to play it on that schedule that I showed you to do. So if I give you columns on the exam, I'm looking for that schedule, right? So don't get afraid. Don't get mad at me. I give you columns. It's usually a hint. Okay? Now, when you do the payback, if the working capital comes back, you don't include it in your denominator. So you know how we're trying to figure out the numerator. You know how we're trying to figure out the number of years of payback? The working capital is excluded, right? Because it comes back. Does that make sense? So it's only when it comes back you exclude. When it doesn't come back. So I think I need to look at the exercise, the mock exercise 12-2, because I may have added and subtracted, but the concept's the same. So I'm going to post something on Blackboard, hopefully today, to clarify if I made the error. Okay? I know a few of you have already emailed me, and thank you for that. I appreciate. Now, the other piece of it that we learned is transfer pricing, right? And if you really look at transfer pricing, you guys, it's not much different than special order, isn't it? It's not that much different than the decision making that we have attempted on special order. It's the same process as transfer pricing. You got to remember, who sets the top end of the price? If this is the range, Who sets the top end? The buyer, right? Who sets the bottom end? The seller. Now, the buyer will always never pays more than what the market, right, calls for. Why would the buyer pay more? Right? It wants to pay no more than the market, right? The seller is going to charge, right, variable costs. But I know they're going to want more than that. Because what's the point? It's no fun doing a business, being in business, just breaking even, right? It doesn't make sense. So now, this does not necessarily mean all variable costs, right? Because sometimes you might have to factor in some fixed cost. Depends on the situation. Because remember, this is incremental. So don't look at it as just variable cost. Look at it as incremental cost. So if I was the seller and my sister company wants to buy the same products from me, I want to know, what is my incremental cost? It may include certain fixed costs. So don't stay with the variable cost concept. The reason why we use variable cost, because for most part, fixed cost is not relevant. It's not incremental, right? Okay, just want to make sure we're on that. The last thing that we learned is ROI, RI, and EVA. And I talked about this already yesterday and Friday, that this is going to be factored into another part of a question. So these are the three methods of how we're going to evaluate the performance of that manager. So once that manager has decided to buy that equipment, or perhaps to do short-term drop a product line, or make versus buy, any decision that we ask from Chapter 4 and Chapter 12, we're now going to say to you, well, now let's evaluate whether that manager did a good job or not. What happens to his ROI? And that's how I'm going to bring that into the exam. So if you understand, and I remember, the formula is very simple, okay? And you're not asked to, right? You're just asked to interpret and apply the formula, okay? So any questions at all on the material, the basic material that I'm asking you guys to know, okay? So let's take a look at the first question. First question to review. Those that came in late, there's some question at the front here. So Andrew, you want to help yourself? They're right at the front. So the first question is, maybe I'll grab a question too so I can highlight. Thank you. So the first question, let me get my highlighter here. This question is all about ROI, right? Okay, so faced with headquarters' desire to sign a new product, so he decided that his division's ROI has led the company for 3 years. He doesn't want to be let down. The product is a decentralized wholesaler with 4 autonomous decisions. The divisions are evaluated based on ROI, with the year-end bonus given to divisional managers who have the highest ROI. Results in the East Division last year were as follows. So this is the results from last year. The company has an overall of 18%. The new product line that headquarter wants the East Division to add would require an investment of $3 million, and the cost and revenue characteristics of the product line. So this is the new. So this is the new. This is the current. Okay? So the first part asks us to compute the division's ROI from last year, and also compute the ROI that would appear if the new product line is added. So now we're asked to look at the before and after. So what would we need to do? Okay, so that's the first part of the required. So for question number 1, this is all about understanding ROI, RI, and EVA. And in EVA, we need to calculate WACC, right? So these are what I call the must-know. So how do we deal with this? So first of all, let's deal with the present, the current situation. First, we've got sales of $21 million. And the new line will add $9 million to that. So the total is $30 million. Now, operating profit is the next thing I need to know, because obviously we're calculating ROI. All we need is operating profit and investment, right? So the operating profit is given to us at 1.680. Remember, operating profit is before tax, before interest, right? So if I gave you net income, all you need to do is back out tax and interest, and you're good to go, right? And the new line is... So how do I determine the operating profit in the new line? So first of all, how do I do that? I got sales, $9 million. Variable cost, I'm told it is 65% of sales. So 65% of $9 million is 5,850. Contribution margin of 3,150. Fixed cost is 2,520. Operating profit is 630. So I know that this operating profit is this one. Okay? And then the total is 2,310. Operating asset, is that given to us? Yep. Divisional operating asset is $5,250,000. And this is $3 million, because we're told that this investment is $3 million, right? And the sum is 8,250. So first, let's calculate the ROI, but I'm going to use the DuPont method just for fun. Okay? So first, we need two numbers from the DuPont. The margin. So I'm going to label this 1, 2, and 3 so I can show you the formula. Margin is 2 over 1. And this one is 8%. The new line is 7%. And the overall is 7.7%. The turnover is 1 over 3. And we know what that is, right? That's sales divided by operating asset. And that is 4 times, 3 times, 3.6 times. ROI is 32. So this is margin times turnover. 32%, 21%, and 28%. Now, you could have been a little bit more sophisticated, of course, right? So it depends on when these assets, this investment was coming in. So in this question, we weren't told, right? We were not told what the, I guess, when this investment, new product, right? If it's at the beginning of the year, then what I would do is I would, because this is supposed to be the average operating asset, so I would have been okay if you took the average of 8.250 million plus 5250 million divided by, right, 2. Right? If you took the average, I would have given some leeway in the marking key that way, right? So again, right, because the formula is supposed to be operating income divided by assets, average operating assets, okay? So if you think it's okay, then you know what, I will agree. If you think you should use the average. So the question is, that's the ROI. Now number 2 says, if you were in Grenier's position, would you accept or reject the project? And the answer is we would reject it, right? Okay. You would definitely reject it because, look, it went down to 28%. Right? Then number 3 says, why do you suppose headquarters anxious? Why do you think they're anxious? Well, remember, company's ROI is 18%. New investment is 21%. So we know that this is much better. So from a company's perspective, right, so company wants to add new product line, right? Because 21 is greater than 18%. Makes sense, right? So this is, the example of this is called goal incongruent. Why? Because the division will reject this, but corporately it's way better than it should. Now, I could take this question. So this is where you need to start thinking about, right, as an examiner. You think about as the person writing this exam question. You could perhaps start to create an NPV question regarding this. So maybe we could create this and then give you guys some cash flow question, and you have to figure out whether they should have accepted this capital project. So this could be a neat little addition to a question, and then once you decide whether we should accept it or not, then you do this part. What's the impact on ROI, right? Does that make sense? Okay. Any questions on that? Now, number 4, what is number 4 asking us? Let's take a look what number 4 is asking us. Number 4 says, suppose that the company's minimum required return of operating assets is 15%, and the performance evaluation using residual income. Okay. Compute the East Division residual income last year, and also compute the residual income as it would appear if a new product is added. Using these circumstances, what would you do? Would you accept or reject? So now they're asking us for residual income. Okay, so again, I'm going to have the 2 columns, the present or current, the new line, and the total. So the operating asset as it was given to us and we've got the minimum required rate of return. Remember, in this course, I'm not asking you to calculate what that is. I'm going to give it to you, right? and we're going to multiply by 15%. And think about this as an opportunity cost, a charge for using that asset, right? So that is $787,500. Then we've got our operating income. Less essentially the charge, right? So it's this one here, right? This gives us an RI of $892,500. So overall, the East Division would accept this project under RI because it'll just add to its current RI. So it does make sense from this perspective to add. So you must remember that one thing that I want you guys to take away from this exercise is make sure you know the pro-con of using RI and ROI. And this question did not have EVA, so you must probably know how to do EVA calculation. And I've shown you two separate calculations in our last class. So it was a web option on our last class on calculating the weighted average cost of capital. Make sure you know how to do that, okay? Does that make sense? Any question on question 1? Okay, let's take a look at question 2, please. So question 2. You've got a company that has an electrical division, and here are the sales and cost data on transformer. So this is the electrical division. The company has a motor division, and the motor division likely to begin purchasing transformer from the electrical. So this is a transfer pricing. The motor division is currently purchasing 10,000 transformer from another company at 38. So this is the market price. And the company evaluates its manager based on divisional profits. So the first part says, assume that the electrical division is now selling only 50,000 transformer each year. So what's their capacity? 60. So we've got the extra 10, right? And they want to buy 10. So we are good. We don't have to give up from our regular customer. And you'll see that it's asking us for what is the lowest price, and from the motor's perspective, what is the highest price. So this is a transfer pricing issue. But look at part 2. I'm going to jump into part 2 for a minute. Part 2 assumes that all electrical division is selling to outside all of its transformer it can produce. So this is where we don't have the capacity. So I've given you two different scenarios, same required from the standpoint of electrical company division, what is the lowest? From the motor, what is the highest? And if they were left to negotiate or interfere without interference, what would you expect the divisional managers to do? And from the standpoint of the entire company, what should the transfer price take place? Okay, so we're going to take a look at this question. together. All right? So this is all about transfer pricing. And remember, I made a couple of comments already that perhaps you might want to include transfer pricing with short-term decision, right? On special order. And you'll see that they're both the same, right? So it'd be no different than the electrical company treating the division of the motor company as a special order. So you start to see that it doesn't really matter, doesn't it? And what if I added in there constraint resource? So let's say the motor has 3 products. And the motor company has to decide which of the 3 products they're going to give up to accept a special order. Does that make sense? We did that example in class. But the example we did, the additional question on transfer price, right, and special order, it happens to be that it was actually chapter 4. It happens to be that the contribution margin per constraint is the same for either 2 products. It didn't matter which one you gave up, right? But what if they were different? So that was the thinking that I had there. Okay. So the first part is, and we're gonna answer this, is what is the capacity? 60. What is the current production? 50. So we have 10,000 idle capacity. So transfer price, the formula is variable cost plus contribution margin loss, sales, divided by number of units transferred. Okay, it's a long formula, but you'll see in a minute why we need it. So we know that the minimum is variable cost, and the maximum is market, right? We said that already earlier. So the transfer price formula is going to be 21 is the variable cost, right? Plus 0 over 10,000. And so that's the minimum. So that's $21. And the maximum is going to be market price, right? So there's that range of transfer price. And if they negotiate anywhere in that range, it's a win-win for all 3 parties, the motor, the electrical, and the company. Right? Because if I was the buyer, if I pay less than 38, I'm happy because it's cheaper than if I buy outside. If I sell it for more than the variable cost, I'm happy because it would have been idle anyway. And company would be happy because the profit stays within the consolidated group. Make sense? Okay. That was part 1, or part 1. Part 2, we need to calculate the transfer price. It's going to be 21. And by the way, the variable cost, what does that mean? Is it just variable manufacturing or all variable cost? All variable costs. Some of you just love to just exclude anything but production. It's all variable cost. The concept here is contribution margin is all variable costs, regardless whether it's product related or period related, right? Mr. Patel? Okay. We're good. Now, transfer price is $21, the variable cost, plus what is the contribution margin? Because now we're at the maximum, right? So I need to give up a contribution margin, and that would be 40 minus 21, 19, times 10,000 units divided by 10,000 units. Now, this, if for some reason we had 12,000, or let's say they wanted to order 12,000, no, that doesn't make sense. Let's say we have 8,000 room, then this would be 2 and this will be 10, right? Make sense? Because you would only give up, right? Sorry, if we have 2,000 room, we would have to give up for 8. So this will be 8. Because we would have to give up 8,000 from a regular customer, but they're buying 10,000 because we're looking for the per unit cost. Make sense? And this will give us $40. So now you can see that the minimum is 40, the maximum is 38. Then you know transfer price, there is none, right? So this is, there's no way the motor company is willing to pay for 40 bucks, right? They don't want to pay $40 for that one. All right, any questions on number 2? Moving on to number 3. So in number 3, you can see that this is a capital budgeting decision, right? And you'll see that this is a hospital that want to buy a power generator, okay? The generator is worn out and must be either be overhauled or replaced. If the company keeps and overhaul its present generator, then the generator will be usable for 8 more years. If a new generator is purchased, it will be used for 8 years. So normally with these capital budgeting decisions, we keep the number of periods the same for 2 options. I know that if you have, perhaps that might not be true in reality, but for this course, we're going to try to keep the 2 decisions, the 2 options, the same period. Okay, so if you're starting to do your calculation on the exam and you're using different periods, then you know you got to stop yourself and say something's not right. Because I would never do that, right? The new generator would be diesel powered with a substantial reduction in operating costs. This is the new, this is the old. Okay, now I like this question is written in a way that's easy for students to see the data. So perhaps, I just want to make a little note, perhaps on the exam, because you know you're going to get a chapter 12, right? Do you know that? Have I given you hints already on that? Like major hints? Okay. So perhaps on the exam, the info will be provided in paragraph form. In other words, it's not going to be given to you in a chart, a beautiful chart that you could see the difference. Maybe I'll give you a story that says the second paragraph will be the new equipment, the third paragraph will be the old equipment, you know, all that stuff. Now, there was that additional question that we did in class. Remember? The big one. Do you remember the name of the question? I don't remember the name of the question. You guys remember? You know which one I'm talking about? Praveen?
The model 472.
Yeah, the model 472. Oh, yeah, you're right. That's awesome. Right? Remember that big question? Please redo that question over and over again. Okay? Now, you'll see, you guys, that they gave us the cost of the new equipment. Okay? Some will be irrelevant, right? Some you're not going to use in your analysis. You have to figure out what is relevant or irrelevant in decision making, right? They gave you the remaining book value. That is so irrelevant, right? When you see the word book value, like that's already past cost, that's already been purchased. Then you've got overhaul need now, that's relevant. Annual cash operating cost, salvage value now, and salvage value 8 years from now. Okay? So, we're going to do this is, we're going to do it two ways. The first way is the gross amount. The second way is the incremental amount. So on the exam, I will tell you specifically which method I want, right? But if you don't like the incremental method, let's say that confuses you, what you got to do is visualize what the gross amount is, the one that you're comfortable with, and just show the difference. Let me show you. Okay, so this is question number 3, and this is all to do with Chapter 12, NPV, IRR, payback, and ARR, right? Make sure you remember all the pro-cons, right? For each method. So, we're going to use a chart. So if I give you columns, this is what I want these columns to represent. Does that make sense? Now, you've got years, cash flow, PV factor, and the rate of return is 16%, I believe, right? And the PV amount. And this would be a description, right? So I will give you these columns. And again, you don't like the columns, then ignore them. Just pretend there are just no lines there, okay? But if I give you the columns, that's what I'm referring to. Okay? Don't send me angry emails. Why'd you give me columns? When I got that email, I actually had a little chuckle. It made my day. So whoever sent that email, thank you. It made me smile. Because I thought, wow, such anger coming through. Cost of new equipment. So now we're going to buy the new generator. So what are the incremental flows, right? Cost of new. And we're going to actually buy it now. And I put minus, okay, as an outflow. And the present value factor is 1. And when we do marking, we love these charts because we just look for those numbers. And if you mess up, we know where you mess up. I'm going to do it separately, Praveen. Can I do it separately for you? Okay, and I'll show you. All right? Now, this is salvage value of old. And again, that's now 2. And that's your 4,000. Is that what you mean, Praveen? No, I'm going to show you in a minute. But this is like, I'm only looking at this one, right? I'm going to buy the new, and I'm going to get $4,000 for, right? I'm assuming I'm going to go ahead and buy the new. Okay? And now I'm going to have cash flow annual, 1 to 8 years, and that's going to be $7,500. And that is present value, okay, 4.344. And then I have salvage value at N, and that's at the end of 8 years. That's 6,000, okay? That's this one, right? And that's 0.305. It's 1830. So this will be an outflow of 46,750. So this is with the assumption that I'm going to buy the new generator, right? So now I'm going to go with the stay, right? Keep the old. So hang in there, Praveen. I'll show you. Okay? So what is the issue here? The cost of the new is irrelevant. I'm not buying a new one. I'm keeping my old. The book value is not relevant either. Right? The overhaul now, that's relevant because I need to fix it, right? Okay. Now, what's next? Annual cash flow cost. And then I've got salvage value at N. And that is given to us here, right? That's the salvage value. Salvage value now is irrelevant in the keep decision, right? Because you're not selling it, right? You could see that there's a favor, right, of 14,000 of purchasing the new generator, right? Now, I might ask you what we call the point of indifference. At what point does this make zero difference between whether I should switch to the new generator or not? Right? That will definitely be asked. Oh, I know. Isn't that horrible? I heard that sigh. Okay, now, the only way to do the point of indifference is you've got to then look at the lowest one, right? The point of indifference would be in the perspective of, right? Because obviously it's better to move to the new equipment, right? So the question will be asked, at what point will cash flow savings go up before buying the new equipment doesn't make sense? So let's say this $7,500 is what I'm, right, the annual cost of running this new generator. How much am I off by for this to be indifferent? Right? So that means that right now I have a benefit of $14,635 from moving into the new generator. I get it. The question that I'll ask you is, right, what would the cash flow be? How much are we off in our estimate before the new equipment doesn't make sense? So what I would do, I would take the $14,635. What would I do? Anybody?
Divided by 4.344.
Correct. And that would be the amount of cash outflow that I'm off by. Make sense? Okay. So I think you guys know how to do that. But let's do the incremental, because I know that's what I like. If we use the incremental approach, how do we do it? Again, we're using the three columns, right? Years, cash flow, PV factor, 16%, and PV. Okay? So always look at it from the perspective of the new generator. You're always looking at decision based on what you want to do. Because obviously someone came to you and said, hey, can we switch to a new generator? So you're always looking at it from the point of view of moving into that new generator. So right now, what is the incremental investment of new generator? So we've got 20,000 outflow minus, so if I move, I'm going to get 20 less, right? the 8. Right? My outflow is 20. But I'm going to save. If I move, I don't have to pay $8,000 to overhaul the equipment. Does that make sense? So that's why it's 20 minus 8. Now, if I move to the new equipment, I'm going to get the salvage value of 4. So that's an inflow, right? Now, I have an annual cost savings of the difference between 12,500 minus 7,500. So by moving to the new generator, I'm going to save on my cost of 5,000. And then, because there will be a difference in cash flow on the difference on the salvage value at the end of the project, I need to incorporate that too, right? Always look at it from the point of view of the new generator. Does that make sense? So this is the incremental approach. And this might be asked. Yes? So this is a salvage value of the new. Okay? And this is a salvage value of the present generator at the end of 8 years. So if I'm going to buy the new generator, I'm going to have $3,000 extra cash flow at the end. That's why you're adding it to here. The difference between 6 and 3. Does that make sense, Summer? Summer, right? No. Is your name Summer? No. What is your name then? Oh, I'm sorry, yes. Who's Summer? Summer? Oh, there you are. I get to know names. Don't worry. By the end of 4 years, I should get it right. And when you get to summer school and you see me there, just remind me your name again. Because there was one girl. Can I tell you a story? So, I'll tell you a story. So, I go to a gym, right? And I work out. I try to anyway. And I've met this girl at the gym, and we chat. You know, whenever we see each other, say hello, how you doing, whatever, right? And whenever we do, like, you know, like a class, she saves me a little spot, right? So we get to know each other. It's been like a year and a half. So one day we're sitting down and we're just chatting, and she looked at me. She says, "You really don't know who I am, do you?" I go, "No, I don't even know your name." I just say hi, right? I mean, you know, I'm in the gym. I really don't like being in the gym anyway, so I try to do as minimal, all right, socialization. I go in, do my workout, and then leave. She goes, "You don't know who I am, do you?" I go, "No." I look at her and go, do you know what I do? She goes, "Yeah." I go, "So are you one of my students?" She says, "No." She says, "You taught me at summer school, SOA, 2 years ago." I go, "Really?" So I don't remember her. So anyways, so I was her instructor. So if I don't remember you, Summer, I will remember your name, though, because your name is Related to a season, right? And Mr. Patel, I will always remember you. Julia. Okay, let's look at number 4. Number 4 is chapter 10, right? Chapter 10. Remember I told you guys chapter 10 is really important? Everything is important, of course. So let's check this out, you guys. They're asking us to prepare a cash budget. Okay, including supporting schedule for cash collection and cash payment. Then the question says, did the business show negative cash for June? Assuming that the owner has no hope of establishing a line of credit, what can we do? What are recommendations for the owners for dealing with a negative cash balance? So clearly, our cash flow should be a negative cash balance, right? Okay. So what are we given? We're given that the beginning cash was June. Then we're told that these are the sales for April and May. There's some cash, there's some credit sales. Then we're told a couple of business rules. I call this business rules, where it tells us that credit sales are collected over 3 months. 50% of the sales in the month of sales, 30% in the second month of sales, and 15% in the third month of sales. So we're told that this is their collection pattern. Okay? Then we're told that sales are collected in the third month subject to a 1% late fee. So we have to calculate the late fee, for which paid by those customers in addition to what they owe. So we need to calculate a late fee as well, right? And it says inventory purchased average 75% of the month's total sales. Of those purchases, 20% are paid in the month of purchase, and the remaining 80% are paid in the following month. We're told a whole bunch of expenses. And then we're told also that the expected sales are $15,000 for the month of June and a credit sales of $50,000 for the month of June. And there is no minimum cash requirement. In our example, in our lecture notes, there was a minimum cash requirement, if you remember, right? So here there's no minimum cash requirement. So we're asked to do a cash budget. So how do we do that? So let's do cash budget for the month of June. So let's start with beginning balance. I want to isolate all the inflows. So first, the expected cash sales for June was $15,000. We're told that in that last paragraph, didn't we? Now, we need to figure out the credit sales. So first of all, for June, there was 50,000 credit sales, and we know that 50% of that is collectible in the current month. That's what we're told. That means that we're also told that 30% of the second month, which means that would be May sales, right? So these are great multiple choice questions, you guys. And of course, the third month will be collected, right? So third month prior would be April. But the $37.50, we're going to get 1%, aren't we, for late fee? So that's an extra $38. Okay, so we're told that there's going to be a late fee. The outflow. First, we have some purchases. Now, what are the business rules for purchases? It's told that 75% of the month's sales, of those purchases, 20% are paid for the month of purchase. So, first of all, for June, what are our sales for June? It was $65,000 times 75%. That would be the cost of goods. And we're told that 20% is paid in the current month. And for May, so purchases are the hardest part here. It's not so hard, right? Then you've got salaries. You got rent. And you got taxes. So altogether, you got 172 negative cash. So the question kind of alluded to a negative cash flow, so that's what we got, right? So the question says, what can we do? Part 2. What can you suggest? How do we improve the cash flow? Matt?
One of the ideas I had was to keep leaner inventory, like 60% of sales.
Well, this is the cost, right? So we can't control that. That's how much it costs us to buy. Yeah. So perhaps what Matt may be referring to is we could perhaps extend our supplier credit, right? Instead of paying them 20 and 80%, maybe we could say to them, you know what, can we pay you, can we stretch it out, right? So the one is definitely for part 2, extend payment to supplier. So Matt's kind of alluding to that, is saying, you know what, can we pay these a little longer? And the other one is obviously increase cash collection from customers, right? And the other one is decrease salaries, because presumably that's the owners, right? So instead of paying him $8,700, can we decrease it for at least a couple of months until we get back on track? Does that make sense? Okay, let's take a look at question number 5, please. Another budgeting question. And this time, we're going to look at production. Because remember, that was one of the things I told you guys that you need to know, right? We're almost done. We're almost there. So, this question, Franklin distributes products to retailers, and one of these products is Super Stick, which requires 4 kilograms of materials in each of the units. The company is now planning a raw material needs for the first quarter, so the third quarter. Okay. Peak sales of Super Sticks occur in the third quarter of each year. To keep the production and shipment moving slowly, the company has the following inventory requirements. Finished goods on hand at the end of each month must equal 8,000 plus 20% of next month's sales. So for those of you that are probably wondering, this is called safety stock. And that's something we're going to talk about in the second half of this course, MGAB03, right? That's called safety stock. And then we have to calculate what that is. So we get to learn that in one of the chapters. But in this question, it's given to you, right? The finished goods inventory on June is 22,000, so we need that. Raw materials on hand at the end of the month must equal 40% of the following month's production for raw materials. And the raw materials on hand is 129,000 kilograms. The company maintains no work in progress in inventory. So sales budget for Super Stick for the last 6 months are as follows. We're asked to look at the production budget, followed by, obviously it says examine the production budget you prepare. Why would the company produce more units in August and July? And then followed by a materials budget. Okay? So let's do this. So the first one is the production budget. So I'm going to use 07 for July, 08, and 09, and 10. This is October, right? So first, I need to look at the budgeted sales. So we know in units, our budgeted sales for July given to us is 60,000, 75,000, 105,000, and 53,000. Now, we need to add the desired ending inventory. And what was the ending inventory requirement? We're told that for July, it's going to be 8,000 plus 20% of next month's sales is 75,000. So this is 23,000. And for 08, it's going to be 8,000 again, plus 20% of 105. And for 09, it'll be 8,000 plus 20% of 53. And for October, it's 8,000 plus 20% of 30,000. So these are my desired ending inventory. I'm going to put a box beside this because this is essentially the sidebar calculation you're going to need. Okay, so this is 29, 18,600, and this is 14,000. So total needs is the sum of these two. Now, I need to deduct beginning inventory, and we're told that this is given to us. So we don't need to calculate that, right? But we can, right? Because it would be 8,000 plus 20% of 6, right? So 20% of 6,000, 60,000 is what? $12 plus, right? Does that work? It should be 20, right? Oh, well, you know what? It doesn't work. But that's given to us. It should work. There's a flaw in this question. Okay. But it should be based on that same logic, right? I'm surprised it doesn't work. Okay. Well, I'll have to fix that. All right. So this would be the 23, and that would be the 29, and this will be the 18,600. So the required production So, do you think you need to know how to do one of these on the exam? Mr. Patel seems to think so, and I agree with him. So make sure you know how to do production budget, okay? Now, we need the materials. So now we've got the production, now we need the materials, right? So again, I'm going to use the columns. So the required production is 61,000. That was the amount that we calculated, right? From part 1. Now, how many materials do I require, right? I need 4 kilograms, don't I? Now, again, I need to add my desired ending inventory. And what was the business rule there? The raw materials, 40% of the following month's raw material needs, right? So for 07, we need 40% of 324. So we know I need 129,600 here. For 08, it's 40% of 378,400. And of course, this will be the same, right? That's the ending, isn't it? Because I'm doing the quarter end. Again, this is just a sidebar calculation to help us determine those ending. So here are my total material needs. Now, less beginning. And again, this was given to us. Does that work out actually? Anybody know? It should be 40% of 244. Does that work out? Out of curiosity. It does not, right? Of course not. Okay. But it's meant to be, right? And this is 129,600, and this is 151,360, and this is 129, right? This is the beginning. So materials purchased. Now, I could add in here, too, the cash outflow, right? Does that make sense, you guys? Okay, we've got one more question left. any questions on budgeting, chapter 10? Okay, let's look at number 6, our final question. So we've got a company, okay, they're an automotive supplier. And they develop a $600,000 machine for assembling a school bus recliner. The machine had been used to produce only one batch of 1,000 units so far. The company amortized $600,000 initial machine investment over 5 years, after which the production of the recliner will stop. The company's expected annual cost will be direct materials, $300,000, direct labor, $120,000, and variable manufacturing overhead, $240,000. Variable manufacturing overhead varies with direct labor cost. What does that mean? That's an important statement. It means that the variable manufacturing overhead is allocated based on labor hours. That's an important fact, because we'll see in a minute how we're going to use that. Okay? Fixed manufacturing overhead is $90,000, excluding amortization, and fixed marketing and admin costs is $45,000 annually. A Japanese manufacturer of special purpose equipment informs the engineering department that in 2 weeks he can deliver a new machine, ideally for assembling the recliner. So there's a new machine from a Japanese manufacturer. This machine is much more superior because it reduces the direct material by 10%, and they produce twice as many recliners per hour. It will cost $500,000 and will have zero terminal disposal at the end of 5 years. Productions and sales are $25,000 per year, and it will be the same whether the company uses an old or the new machine. The current disposal price of the internally developed machine is $60,000, and its terminal value in 4 years will be $30,000. So using 16% rate of return, what is the NPV? That's one. Number two, it's asking us the roll of book value. We're going to come back to that. So let's do the first one first. So I just wanted to kind of lay out, particularly when you have a complex question like this, okay? You want to lay out exactly how your cash flow, right? So that you can see, and you want to make sure you calculate the right period. Now, the basic NPV calculation requires a couple of things. So if I do a timeline, so this is time equals 0, time equals 1, time equals 2, and so on, right? What we want to say is we want to look at the reoccurring cash flows here, or savings. So these happens each period. And remember, we made the assumption that with time value in money, all of these happens at the end of the period. So remember, that was one of the assumptions we made, right? So if we look at these cash flows, itemize them, because sometimes the cash flows savings aren't the same. If they're not the same, it's okay. You can treat them individually, just like we did in that other additional question that we did for chapter 12, right? Now, at the beginning, you're going to have a whole bunch of cash flows, right? So here, normally, you'll know that there's an initial investment required. Sometimes there's work and capital needs. That's an outflow. And there's a current disposal of old. So these are often what you'll find at the beginning of the investment. At the end of the investment, you'll sometimes see work terminal values, okay, or the incremental difference in terminal values of new versus old. We saw that in the other capital budgeting decision, right, you guys? And always, but never always, right, a working capital recovery. Sometimes the question will say, hey, this much comes back. Right? So these are often what you'll find at the end of the cash flow. So what I do when I do one of these and the question is starting to look a little messy, then I start to lay it out on a timeline so it gets me, right, it gets me straight to the story. Because sometimes the story, particularly this one, is a little bit more involved, right? It didn't give me a beautiful chart just like the one that we saw, the old generator and the new generator, right? So that is the question. So let's do this. The first part of the question requires us to analyze the incremental cash flow. So the first one is we need to analyze the relevant cash flow. So this is the current machine. This is the Japanese machine, right? And this is the incremental. Okay? So, sales, we know it's irrelevant because it told us, regardless which machine, it doesn't change our sales forecast. If it does, we would factor that in. Right? Next, cost. What happened to direct material? We are given the current machine. The direct material is $300,000. And we're told we're going to get a 10% savings, right? So that means that the Japanese machine, we only need $270,000 material. There's a $30,000 incremental savings in cost. It's a positive because it's a cash flow, inflow, right? Now, direct labor. We're told it's 120, right? What did the question tell us? What did the question say? Twice as many per hour, which means what? It's going to be half the cost. So this is 60. So the incremental savings is 60. Do you see that? Variable overhead. How is it allocated? First, we need to know it's 240. How is it allocated? It's allocated based on direct labor hours. If the direct labor hours is half, that means that the variable overhead is also half. Does that make sense? Remember I told you guys in class that this is the hardest part? If I gave you a chapter 12 question, the hard part is to find that incremental cash flow. Right? What about fixed overhead? What about marketing? What about admin? Irrelevant. It doesn't matter. It doesn't change. If it does, I'd put it on here, right? So I've given you way more information than you need. So if you feel like you didn't use all of it, you're okay. Because the whole point behind this analysis is I want to buy the new Japanese equipment. Does it make sense? Okay. So the total cost goes from $660 to $450. So this is $210,000 savings. So now I'm going to So I'm going to show you two ways. I'm going to show you the gross method and the incremental method. Can I do that? Okay. So how do I do that? So let's do the, again, years, cash flow, PV factor, and PV amount, right? If I look at the internally developed machine, what are my cash flow? So first of all, my cash flow from 1 to the 5 years, right, is 660. By the way, is this relevant? 600,000? It says the company has developed a 600,000 machine. They only used it for one batch. They only just used it once, and then they decided a Japanese came in and said, I have a better machine. Is that relevant? No. They just spent it. It's not relevant in our decision. It's sunk cost. It's already done. It's already paid for. It's already been incurred. So that's not relevant. That's why under the internally developed, I'm only looking at the cash flow. And this is 3.274. Disposal at year 5. So I'm going to sell that equipment for $30,000, right? And this is, by the way, using 16%, right? So this is inflow. This is outflow. So I could have done it minus, right? It doesn't matter because these are all outflows. That's my net cost of continuing to operate the old internally developed machine. The Japanese machine, we need an initial investment, which is now we've got a current disposal of old machine. And And we've got cash flow operating costs from 1 to 5 years of 450. Yeah, I'm doing everything the opposite, Praveen. I'll show you in a minute, okay? Net outflow. So these are my net outflow. So my outflow are positive, my inflow are negative. So if I want to keep it the same, then I will change it for you, okay, if it really upsets you. Let me show you. I'll put a bracket here. I'll take this off. I'll put a bracket here. Is that better? Does that make you feel better? No angry emails, okay? I'll just press delete. Okay, so check this out. Which is better? This is a less outflow, isn't it? Japanese. So therefore, in favor of the Japanese machine. And that difference is 233,260. Okay? Now, of course, I'm going to ask you to do the incremental method. So how do we do the incremental method? We're almost done, you guys. We're almost there. Hang in there. I have another review class at noon, so I got to make sure I'd be ready for that one. Okay? Years, cash flow, PV factor, and PV. And this is the incremental approach. So first, what is the initial investment? So that's minus 500,000 less disposal of old. So my net investment is 440. So initial investment, which is now, it's going to be minus 440. So this time, Praveen, I'm going to use brackets. Okay. So this is really calculating the investment, right? Then I've got cash flow 1 to 5 years. And that was the difference, right? Remember we calculated the difference of savings? Remember that? From this chart? That's the $210,000 savings. I'm going to factor in. And this one is a positive because it's a savings. Buying this equipment saves that much, okay? And the difference in terminal value at the end of 5 years, and that would be 0 minus 30. Remember, the old machine had a $30,000 terminal value. The new one did not. So I've got to incorporate that difference in terminal values. Lo and behold, that should be the same as the total approach. So if I said to you, prepare the analysis, NPV analysis using the incremental approach, that's what I'm looking for. Much easier. Get to the point. Okay? Now, for part 2, it's asking us for book value. Is that relevant? No. Why? Sunk cost, right? Number 3, payback. How do we calculate payback? over the, right. So the initial investment is 440, right? Right? And cash flow, it's the savings. 440. How did he get 440? It's this number, right? Am I right? Now, number 4 is asking us, as a manager who developed a $600,000 machine, you're trying to justify not to buy the Japanese machine. So you are questioning the accuracy of the operating savings. So what are they asking me? The point of indifference again, right? So right now we're showing a 233, 260 in favor of the new machine. So I'm going to take that divided by the PV factor, annuity of 3.274 to give us 71,246. Therefore, the savings should be off by so the savings drop by 138,754. Okay, I'm going to be indifferent. I'm going to keep my old machine. Another way of doing it, you guys, is this. Using the incremental approach, so let X equals the annual savings. So we know that it's the NPV equals 0. So 3.274 times X minus the original investment after you take away the current salvage value, disposal value, minus 14,280, which is the present value of the difference in terminal value. X equals 138,553.82. So therefore, the difference is 210 less 138,753.82. That difference is 71,246. And that's the number that I just calculated, didn't I? Okay? So that's another way of getting at to the same question. All right, you guys? How are we doing? So that completes the review. Any questions at all? Are you guys ready? All right, thank you, everyone. Good luck on Thursday. I'll see you at 9 o'clock.